Hi, welcome to our group presentation on the Engineering Institution of Zambia. Please enjoy. Our presentation will follow this structure: a company overview, a deep quantitative analysis covering the different ratios and cash flow, a critical look at earnings quality, a note on accounting standards, and finally, our investment decisions. So, to jump straight into it, we'll consider the company overview. Here, we will discuss everything there is to know about the Engineering Institution of Zambia. So we say that this is just not a typical company. Instead, it's a statutory professional body that was established in 1955 and operates under the EIZ Act of 2010. So it does not compete in markets, but it holds a regulatory and leadership position where it oversees engineers, supports and trains, and also advises the government. When it comes to financial reporting, we see that it prepares a statement in full compliance with the IFRS, including consolidated statements with its subsidiaries, EIZ Properties PLC, which is exempt from taxations, which is a key point that enhances its profitability. Next, we're going to consider quantitative analysis. Here, we'll begin with the profitability and efficiency ratios. And the first one on our list is return on equity. Given the bar chart there, we see that the EIZ created a strong value for shareholders because return on equity was a healthy 18.2% in 2021, 15% in 2022, and 16% in 2023. Next, we have the net profit margin, which tells a similar story of strength because it had 24.7% in 2021, 19% in 2022, and a recovery to 21% in 2023, which clearly shows an excellent cost control and an ability to turn sales into profit. Next, we have the gross profit margin, and this shows that the gross profit was exceptionally high, consistently above 79%, peaking at 86.7% in 2021. This clearly indicates powerful pricing ability and control over direct sales. And lastly, under the profitability and efficiency ratios, we have the operating profit margin, where in 2021, the institution had a profit margin of 27% and 18% in 2022 and 22% in 2023. So it's clear that the institution returned 18 ngwe and 22 ngwe in 2021 and 2022 respectively from every 1 kwacha of revenue, clearly showing that there was strong operational efficiency and financial health. Next, we will consider the liquidity and solvency ratios, and the first one is the current ratio. As we can see from the bar chart, it is clear that the ratios were rather alarmingly low, as in 2021 we had 45%, 58% in 2022, and 93% in 2023. This clearly means without external help, EIZ would struggle to pay its short-term bills. Next, we have the quick ratio. The, the quick ratio is more like the current ratio, except it excludes inventory as it focuses only on cash, marketable securities, and receivables. And because EIZ Properties is a service providing institution and does not hold inventory, therefore its quick ratio is the same as the current ratio. Next, we will consider the cash ratio. And this ratio looks at only cash and cash equivalents versus current liabilities. And the institution's ratio improved from 0.29 in 2021 to 0.49 in 2022 and further to 0.65 in 2023. And while the ratio remains below the unconventional benchmark of 1, the steady upward trend highlights improved liquidity and stronger cash position. Next, we move to the debt to equity ratio. And we see that the debt to equity ratio jumped from a moderate 0.53 to 0.58 in 2023. This significantly increased financial risk. And this is because the company was funded mostly by members' equity and not external financing. Hence, the institution is not heavily debt reliant. Next, we have the equity ratio. So this ratio tells how much of the institution's assets are funded by members' equity instead of debt. And it is clear that the proportion of assets funded by equity dropped from 67% to 55% in 2023, meaning great reliance on debt funding. Next, we have the efficiency and activity ratios, and the first one is asset turnover. So the asset turnover ratio improved to 0.98 in 2022 but dropped to 0.73 in 2023. Therefore, this sales efficiency did not translate into profit, meaning they were generating revenue at a significant cost. Lastly, on the ratios, we have the receivables turnover. Therefore, the story for the receivables is that it was positive because the ratio was very high in 2021 at 20.6, and in 2022 it was at 54.5, showing superb credit management. And by 2023, they had no receivables, suggesting a shift to up profit payments, which is therefore great for cash flow. Next, we have the common size income statement, which shows that EIZ has a high cost operating model because its profitability is highly sensitive to controlling these administrative and operational expenses. And this is seen because in 2021 and 2022, the gross profit margin was exceptionally high but fluctuated from 86.7 in 2021 and dropping to 79.4 in 2022 and eventually recovering. Next, we have the common size balance sheet. This shows that EIZ is actively de-risking its short-term liability position. De-risking its short-term liquidity position by shifting its funding structure towards long-term debt and equity, therefore creating a more stable, though more leverageable capital base, because it is clearly seen that members' equity shows a small but steady increase, which is funded likely by retained earnings from their strong profits. The key trends in operating show a dramatic transition because in 2021, the company was largely self-funded by operations, and by 2023, operational cash generation had collapsed and the company became dependent on financing. Now we will consider the free cash flow, and we see that the free cash flow to the firm was positive in 2021 and 2022, but it turned negative in 2023. And this is a key warning signal that operational cash could not meet reinvestment needs. Next, we have the cash return on assets, and we see that this shows how effectively the institution uses its assets to generate cash. And we see that through the years, there was a decline in the cash return of assets, which indicated that the institution was struggling to turn assets into cash, which could affect its ability to pay debt and to reinvest. Next, we have the cash flow to revenue ratio, which measures how much cash an institution generates for every quarter of revenue. And from the 3 years, we see that 2021, the firm had 0.42, which indicated that the firm was relatively good at turning sales into cash. And by 2023, the ratio had declined to 0.19. Therefore, the revenue was not translating into cash, which may signal collection or operational issues. Next, we have the cash return on equity, and this measures how well members' equity generates cash. And we see that through the years, it declined from 2021, where there was a return on equity of 57.3%, to 2023, where there was 19.9%, which means that the firm was generating cash but not efficiently. And for a tax exempt institution like EIZ, though, this is normal. Next, we have the cash to net profit ratio, and this ratio compares actual cash collected to the reported net profit. And through the years, we see that it has a positive sign as the cash generation exceeds accounting profits. Therefore, with the increasing positive ratios, we see that the cash generated was less than the accounting profit, signaling that this therefore signals collection issues or non-cash issues, because and this is because the ratio in 2023 had dropped. We now move on to the earning and quality and red flags section. And while we found no evidence on one-off items, an investor must watch receivables closely. And the takeaway is clear: for the business to prioritize the strength of their cash flow over their reported profits, because lack of this can lead to major red flags, which are earning qualities, because in all 3 years, net income was higher than operating cash flows. And this gap means that profits are reliant on accounting accruals, which is that revenue is booked before any cash is collected. We therefore move to the IFRS versus the US GAAP and investment decisions. So under this, we see that the Engineering Institution of Zambia uses the International Financial Reporting Standard. If it used US GAAP, its earnings would be more volatile due to different fair value and therefore different impairment rules, therefore making IFRS a more suitable framework for their reporting. Therefore, from our analysis, it is clear that the Engineering Institution of Zambia presents a very mixed picture, which is strength and weakness. Strength in its profitability, tax-exempt status, and a strong equity base, whereby it has several weaknesses, which is several short-term liquidity constraints and declining cash conversion efficiency. Therefore, when it comes to the point of whether we should invest or not, the advice would be to proceed, but with caution, because this investment is best for an investor with a medium to long term horizon. As stated earlier, based on our analysis of the Engineering Institution of Zambia, it is seen that we would recommend that the investor proceed with the 1.5 million investment, but with caution, while monitoring liquidity management and operational efficiency, because the company demonstrates strong profitability and consistent capacity to generate cash flows, which signals long-term financial stability and potential for value creation. That is all my group had for you on the analysis of the Engineering Institution of Zambia. Thank you so much for your time.
Have you met them yet?
Met who?